Hey, Julie, you may have gotten muted yourself. It looks like you started, but
There we go.
there it is.
Good afternoon and welcome to the SILA Foundation May webinar, a financial industry primer, a beginner's guide to cracking the code of finance. My name is Julie Mendel and I'm the education trustee for the SILA Foundation. Before introducing today's speaker, I have a few housekeeping items. This webinar is 1 hour in length and is being recorded. Within the next week, you will receive a link to the recording and a post-webinar survey that we would appreciate you completing. We ask that you mute your microphones and turn off your video so the focus stays on our speaker. We also ask that you put your questions in the chat box. We will be monitoring and posing the questions to the speaker on your behalf, and we'll answer as many of the questions as we can in the time we have available. So, are you ready to cash in on some knowledge? This interesting webinar is your golden ticket to becoming fluent in the lingo of the financial world. Designed for true beginners, we're going to help you balance the books of your understanding. No prior assets required. We'll bank on real life examples to compound your confidence. We're going to have a sensational time. Today's speaker is Dave Meshkoff, partner and head of learning innovation at Naughton Marks. His mission is to make FINRA exam training engaging, approachable, and enjoyable. He has trained and coached tens of thousands of students to exam success in memorable and understandable ways. Dave previously practiced bankruptcy law and has worked on well-known cases like General Motors and Lehman Brothers. His legal expertise and training and understanding of the legislative and rulemaking processes allows him to keep all of the Naughton Marks courses up to date. In addition to training individuals to pass their FINRA qualifications, he also delivers executive one-on-one training. He's a ski instructor and a yoga teacher. Please join me in welcoming Dave Meshkoff to our virtual webinar stage.
All right. Thank you, Julie. Wow, that went deep into the background and bio. I love it. Thank you. And joining me is also my colleague, Barb, who will be helping out throughout the day. I know a lot of you know Barb. So really grateful that you're all here. Can a couple of people just give us a little heads up in the chat? Can you hear us? Can you see us? The truth is, I just want to see that the chat's working. So give us a little hello, good morning, good afternoon, wherever you might be. Let's see. There we go, Jamie and Cheryl. Thank you, Tammy. And what I'm going to try and do today is, present a whole bunch of information. We're going to get info to you, but we'll make it a little more interactive. Use the chat. Barb's going to be helping me manage it, responding, replying sometimes. I'll be asking some questions and you participate, and it's going to help you stay focused and help kind of make the light bulb turn on. So this is what we do in our courses, and that's what we're going to do today. Julie gave such a great introduction with all of those jargony words. I don't know if you all heard them in there. There was interest, there was cents, there were dollars, there were books, there was balancing. We had a lot of good stuff going on. And what I hope to do today is kind of break down some of that jargon and make sure that at the end, you have a little bit of a better understanding of finance and investing and a couple things like that. As it said on the prior slide, none of this is actual investment advice, but hopefully it lays a foundation and gives you some ideas as to what you might want to think about or talk about with whoever you make your investments with. So here's a little bit about us. Again, that's me on the left, Dave, that's Barb on the right. I think it's time to get right into it. Here's what we've got on tap. So we're going to talk a little bit at the outset about just like, what is this idea of investing? And that's going to kind of be the angle and the target topic today. We'll talk about what it means to invest and why we might do it, and then some of the main vehicles people invest in: stocks, bonds, mutual funds. Then we're going to talk about within those, what are some of these other ideas like diversification or time horizon, different account types that you might put those investments in. We've got a great giveaway at the end. It's going to be very fun, very exciting, especially if you like the program. Hang out for that. And then we'll take about 10 minutes of questions, time permitting. How fast we go will depend on how engaged you all are in the chat with us. So there'll be a little bit more, a little bit less time, depending. So with that, let's get right into it here. And let's just start with this idea of an overview of investing. And what I want to do is try to kind of pull back. So this is your 10,000-foot level. When you're thinking about finances, you're thinking about investing, you're thinking about money. A couple of things I always like to start with. The first is, we want to think about a budget. And budget's often one of those words that it's kind of scary. You kind of know you should have one, but you don't have one. And we're not going to really talk a lot about budgeting, but I do want to just lay this out, that a budget is how you control your money. So as you think about this as part of a larger series of education or something like that, budgeting is a key point in you telling your dollars where to go instead of your dollars just going wherever they want. The next idea is an emergency fund. I think it's really important whenever you're talking about investing that you at least raise the idea that all of us, if we're able, should have an emergency fund of cash, liquid, maybe it's in a bank account, so that in those unexpected eventualities, you're able to tap that cash instead of needing to hit your investments. And today we're really going to focus on the investment line here. That's what the focus of this presentation is. But I think it's good to put it in context of making investments as a part of a larger financial story. And the other side of that story, which I know might be nearer or dearer to some of you or your firms, is of course insurance. And the last thing I'm going to talk about on this slide is one of the framings that I really like is to think about investing and insurance together. Investing is you're taking on risk, and in exchange, you're going to be getting returns. We're going to talk about how that works. So that investing line that we've highlighted there, taking on more risk, hoping to gain. Insurance is where you're de-risking. You're taking risk away. You're maybe paying a company like maybe some of the ones you work for premiums for those companies to take risk off my plate, like my home insurance, my car insurance, my life insurance, disability insurance. So I like to think about, are we putting risk on, hoping to get gains, or are we taking risk off and paying somebody else to bear that risk? So that's just a big kind of overview of finance, investing, money. In this presentation today, let's take a look at some of the investing pieces.
Hey, Dave.
Yeah.
Can you tell us what on the previous slide? Can you just tell us what YNAB stands for, or Mint? We all know what Excel is, but on the budget.
Oh yeah, YNAB. It's a website that stands for You Need a Budget. So it's just an example of one of the free tools you can use if you did want to get a budget. That's YNAB.com, I think is what it's called. You need a budget.
Is it free?
I think it is free. I think it is. So
Awesome.
budgets don't have to be fancy to be effective. That's the other thing to keep in mind. All right, so we're looking at investing, and that's going to be the focus of today. So let's dig in for a little bit. What is investing? When people talk about, oh, like I'm investing, oh, I've got these brokerage accounts. What in general are they talking about? Well, you pull back, and what they're doing is they're putting money, allocating, that's even a fancy word, right? They're taking some of their money or their resources and putting them into an asset or a project or a venture or a business. And here's the key point. Why are you investing? Because you expect to generate additional income or profit over time. So we can spend money on a lot of different things. When we think about what does it mean to invest, we're going to be putting that money into this thing, hoping that we get more money back over time. That's the key idea. Now, many of you may have investments, and we'll kind of talk a little bit in generality about that. Some of you maybe haven't started your investing journey, and that's okay too. Hopefully, by the end, you'll kind of understand why starting earlier is pretty beneficial. And even if you didn't start early, the best time to start might be now. So let's talk about some of these key ideas. Key ideas. Risk and return. Who's heard of this relationship? Risk and return. Put it in the chat. Give me a thumbs up. Give me a me. Give me a good to go, like GTG, good to go. People heard of risk and return, right? Higher risk, what am I going to get? If I say we're going to do a higher risk thing, what are we going to get? What kind of return would you expect? High risk, high return. All right, Joseph gives a thumbs up. I don't know if he was giving a thumbs up like high or like good.
Yep, people are saying higher, thumbs up.
High risk, high return. Awesome. Right, so that is a standard principle in investing. If you want the return, you're going to have to take the risk. If you're not willing to take the risk, then you're going to get a more modest return. General principle. Then there's this other idea, diversification. We're going to talk about it a little bit more, but this is the idea where we're going to spread out our investments. And what's cool about diversification is we lower risk, but with diversification, what do we think happens with the return? So we add diversification, risk goes down, but return, the idea is at least, who knows, stays flat. I don't know if you can see my thumbs. And my kid made me this bracelet, so I have to wear it today. I just got it last night. So risk is down, You put diversification into the mix, the return kind of stays flat. So there's a little bit of magic there where you're spreading out investments. We'll talk about that. Same thing with time horizon. When we think about time horizon, we can think about investments as being for short terms, medium, or long term. And I want to talk about compounding. Compounding relates to your time horizon because compounding is as your returns come back, you keep them invested and then they start earning. And so the curve begins to get really powerful. We'll show some graphs about that. So these are some of the core elements of investing. Down at the bottom, we always want to think about why we're making this investment. What is the goal of the money? Right? It's not just to make more money, but to finance a thing like retirement or education or financial independence, or I want to buy a house, whatever it is. So these are some of the things that we're going to carry through when we start looking at the different vehicles. Barb, any questions come in that we should address before we jump into the specifics?
Nope.
All
Everyone's
right,
on track.
let's do it. All right, so we're going to talk about stocks. Who owns stocks? Anybody own stocks that they're willing to share in the chat? If you want, no obligation, of course. Stocks, maybe you know the ticker, or maybe you know, I own some stocks, but I don't even know which ones, just in my 401k. That's a great place to have. That's a great place to have them. So we're going to talk about stocks. That's a share of Disney stock, as you can see. We're going to talk about bonds. I bet a lot of you own bonds and don't even know it. I bet a lot of you own these instruments. And then we're going to talk about funds and things like mutual funds and exchange traded funds, where we put all these investments into one big basket. And here's the first callback. If you see a basket that's got stocks and bonds and commodities, cash, real estate, unit investment trust, that's that fancy egg with the UIT. What have we introduced into that basket that we just talked about? What have we introduced in this fund? So maybe our risk went down a little, but our return expectations stayed flat. Anybody got it? There it is, Carol, Cheryl. We added a little diversification, and
Starts
that's
with
one of
the
the
D and
reasons.
ends with aversification.
Oh, there you go. It starts with the D and ends with diversification. Yeah, that's one way to do it. So that's one way to easily achieve diversification by being like, I don't want to pick all the stocks. I don't want to pick all the bonds. I want to talk about the funds. So we're going to talk about each of these now in turn. So let's take a look at stocks. And when most people think about investing, this is what they think about: the stock market, buying shares, things like that. First thing to know, what are some of the other words that are used in culture, in the financial press, to describe shares of stock? Well, you might see stock, common stock, preferred stock. They may call it shares. You might see equity. And equity means ownership, because all of these represent ownership of a company. Companies issue shares of stock. For example, Disney issued that piece of paper that represented 100 shares of the Walt Disney Company. And if you own that piece of paper, you own a tiny sliver of the Walt Disney Company. Now, if you own 100 shares of Disney, are you going to own a big slice or a small slice? What do we think? 100 shares of Disney. Big slice, small slice. Are people chatting right to you, Barb? I'm getting it. All right. Small. Erica's got it. It's small in all caps, right? Because unlike this company here that split itself up into 16 slices, Disney has sliced itself up into 1.8 billion slices. So if you own 100 shares, that's fantastic. That's great. But just remember, your slice is like, it's not even like double cut kids pizza party slice. It is way, 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 way thinner. So you buy that share of Disney and you own a tiny slice. You may think, well, what do I care if I own a tiny slice? Well, it's not just that you own that slice, it's that the whole pie can get bigger or smaller. Yeah, Willem is right. And if you're lucky, you got pepperoni slice going. So let's say you own that slice of Disney right there. Well, if Disney becomes more valuable because they open up new parks or the movies are doing good or Disney Plus is streaming and everybody's subscribing, watch what happens to the value of your slice right there. You can see it. Disney's getting more valuable. You own the same percentage, you own the same slice, but the slice is bigger because the whole pie got bigger. And that's the upside. And that what we just saw is appreciation. the value of that same share has gone up because the pie of which it is one slice has gotten larger. And that is a reflection of the business that Disney does, that people are coming to the parks, they're watching the movies, they're buying the merch, whatever it is. But is it a one-way street? Can shares of stock only go up? I mean, you all know the answer, right? You know the answer. Who knows what's about to happen to that graphic because I've been working on my PowerPoint animation. You know what's about to happen to that pie, right? What goes up must go down. Exactly. So parks are closing, the movies are bombing, people aren't buying as many Elsa dresses, and the value of that share has gone down. And that's called depreciation. And that's what's going to happen. The stock's price is going to go up and down. But what will happen to you as the owner is you will make money based on the difference of the price you paid for those shares and then ultimately the proceeds that you receive when you sell. And that's called a capital gain or a capital loss. And this is a term that I always like to just kind of make sure we're all on the same page of. When you see the word capital, what do people think about? Capital gain or capital loss, capital expenditure. Because I have a really good way that I work this. Yeah, Colleen's got it. Tammy, exactly. Money. It's a money gain. I don't know why they didn't call it a money gain or a money loss, why they had to use a new word to call it what it is. So anytime you see that word capital gain, capital loss, it's just, oh, that's been a money that I've gained because I sold or money that I lost. And the third thing that Disney can do, and many companies do, they don't have to, but many do, is pay a dividend. And that's just a distribution where Disney's like, hey, this quarter we did pretty good. We made a whole bunch of money. Who does that money belong to? Who does the money that Disney made belong to? All of its owners. And we know who the owners are because they have shares of stock. So take a look at the Disney chart here. This takes us back a couple years. Don't worry about the specific numbers. But what we're looking at over 2013 through the end of 2017 is the price of Disney stock. And you can see at the bottom, every quarter, they would make a distribution. They would pay 36 cents, 39 cents, 43 cents, etc., to whoever held those shares of stock. And then if you decided, you know what, I like Disney, and you buy it at 110, right in the beginning of 2015, take a look. You're going to start getting those dividends. You get that amount per share. And then you decide, I want to sell it. Is this a good story, bad story? Good investment, bad investment in terms of the outcome here. You bought at 110, you got like $2.50 in dividends, and then you sold at 95. You have a capital loss of 15 bucks.
Don't sell, they're saying.
Yeah, don't sell. Hold. You got to play the long game.
Mhm.
But that may have been the decision you made. And that can be a story that happens with stocks. Different person, they buy a 110, they hold until late 2017 when they sell at 135. Now we can see a capital or a money gain of $25 in at 110, out at 135. I capture that $25, plus I've got all the dividends in the period. And that's one of the ways that common stock works. You could decide, I want to buy these shares of this company or that company. So that is one of the ideas around stock. And we're going to come back to some of the other features we were talking about before. What about bonds? What about bonds? So before I move on, questions about stock? Good to go?
And nothing here, yep.
Okay, great. So a lot of people are familiar with stocks because they're kind of in the culture. We see them in the movies, we read them in the press. When we invest, we think about them. And what bonds do is a little bit different. So when you hear the term bond, I want you to know some of the other jargon. When people say bonds, they're talking about fixed income. We'll talk about why. It's because you're going to get income that's fixed. It's not going to go up and down. It's not going to be different dividends, 50 cents, 49 cents, 36 cents, 58 cents. It's a fixed stream of income. So you know what they call bonds? Fixed income. It kind of makes a lot of sense. And then you also hear the term notes. That typically means like a medium-term bond. Bills, that if it typically means a short-term instrument. Sometimes people just call them IOUs because that's what they are. Because what a bond or a fixed income instrument or a note or a bill is where you, the investor, take your money and loan it to a corporation, to a municipality, to a government, maybe a foreign entity, and they're going to pay you interest. Just like if you've ever bought a house or you ever bought a car and you took a loan, the bank gave you money in one lump sum and you paid it back over time. This is the same story, just now you're the bank. You're the one making the loan. So you're the one that's going to earn the return. And so bonds work where you, the investor, give $1,000, often bonds typically have a face value of $1,000, to the borrower who pays you interest, as we were just saying, although you may see the term coupon. And then at the agreed upon time, will return the principal or the par amount to you. So if we go, I'll show you the image in a minute and show you exactly how this works. But the other thing you can do with a bond is you can sell it and you can have a capital gain or a capital loss, just like we saw on the share of stock. So you bought the bond, you've been getting interest, and then you're like, I don't want to do this anymore. No problem. You can sell the bond. So we've got some of the jargon. We've defined the way the instrument works. Let's go through an illustration. So here's your bond, upper right. That top part, that's the full page, that represents the right to receive the par value at maturity. There would be an amount and there would be a year and a month when this bond is coming back. So it might say literally $1,000. It might say Jan 2030. And if this was a bond that I held in January of 2030, I would get $1,000 in exchange for that top part of the bond. Oh, this is a 5-year bond. Yeah, perfect, 2030. Now, between now and 2030, what do you think you should get? Because you don't have your $1,000. You took your $1,000 and all the opportunities that that affords you, buying a new phone, going out to dinner, going on a trip, whatever you want to do. You've foregone those today because you gave that $1,000 to a bond issuer. So what is that bond issuer going to give to you? Give me some of the words we just talked about. Yeah, interest. Good, Carol. What's another term? It's up on the screen that they use to describe paying you for the time that you didn't have your money. It's interest or anybody getting it, Barb? There it is,
Come
Carol.
on, there we go.
Your
Thoroughly in.
coupon payment. Your
Yeah, here we
coupon payment. And so every 6 months, you collect, while you own this bond, you collect a coupon. Now, the history is pretty interesting. Used to be, let me go back for a minute just to that like oldie time bond that I had a picture of. Where's my oldie time bond? There it is. This is a U.S. Savings bond, $1,000 from the U.S. government. And you would literally take that little picture of Abe Lincoln on the bottom. You would take it to any number of banks or broker dealers. You would give them that coupon. Like you would literally, it's called clipping a coupon because you would clip it with scissors, like clip, clip, hand it in, and they'd be like, oh, Dave, great to see you. For that coupon, you're entitled. This one, you can actually see it's 2.5%. So they'd be like, Dave, you are entitled to $12.50 for this coupon because you get 2 per year. And so you would clip the coupon, turn it in, and then the paying agent would pay you. So how does a bond work? Let's take a look. You bought the thing, 6 months later, boom, $45. You don't have to do the coupon business anymore. They just send the money right into your account. Boom, they send the money into your account. They send the money, they send the money, they send the money, all the while until the very end when they give you your last coupon and $1,000. So at the end, at that after 5 years, you would go to the bank not only with your last coupon, like you can imagine, it would just be You would just have this one left. You would also give the whole big one, and they'd say, oh, that's a big one. That's worth 1,000 right there. So you turn in the bond and the coupon, and you would get your money. Anybody see Die Hard? Anybody know see Die Hard? I think it was Die Hard 2 when they rob the Fed Bank in New York and they steal what's called bearer bonds. They steal the bonds. Yeah, the Christmas movie. Ah, Michael Verdi. He's a friend and colleague.
Of
They
course.
steal the bonds. They steal the bonds, Barb, because then every 6 months, the criminals they clip the coupons. I always picture these like really big like criminals. They're like clipping, and they show up and they're like, "Oh, we got these coupons." Nobody knows who they are. You don't write anything. There's no name on it. Whoever holds it, whoever bears the bond, literally bearer, like physical possession, they're the ones entitled to it. So that's why if you're going to steal bonds, you want to steal bearer bonds. Problem is they don't issue them anymore because of problems like I just described. So
Sort of like the
that's
old
the
green stamps.
yeah, exactly, exactly. So that's the arc of a bond. But I also told you, like these things can last years, 5 years, 10 years, 20, 30-year bonds. And you might be like, ah, I kind of want my $1,000 back. So are you allowed to sell the bond? What do we think? Yes or no? Give me a yes or no. Can you sell the bond? And if you think yes, when? Can you sell the bond? And if you think yes, when? Jamie says yes. We got a seller. Anybody else, Barb? We're taking 100% correct. Nicely done. You're allowed to sell the bond anytime you want. Anytime you want on this whole 5 year period. On day 2, you could sell the bond, or on day 4 year, 363 days, you could sell the bond. And anytime in between. You're allowed to sell the bond whenever you want. And somebody else will step into your shoes and they'll start getting the $45 and then the $1,000 at the end of the life of the bond. Now, there's tons and tons of kinds of bonds out there, ranging from very safe, like our US government bonds, although that's been called into question a little bit recently, nonetheless, very safe bonds. We have agency bonds, things that finance residential mortgages, like you've heard of Freddie or Fannie or Ginnie or Sally, all these agencies that borrow money in furtherance of a specific government goal, like allowing people to buy homes, so mortgages, allowing people to go to school, that's Sally Mae, things like that. So these ideas we finance by borrowing money, and that's the way that we do that. Municipalities, your town, your city, your school board, your local water district, all may borrow money by issuing bonds. So if we want to build a town hall, for example, we're going to need a big bunch of money today, not just the tax revenues over time. We're going to want a big chunk of money today. So how do we borrow today? We do a bond. And so we might sell $25 million worth of bonds. We get that cash today, and then we pay the lenders back, all of you as individual bondholders, over the next 10 or 15 or 25 years.
Is that like a millage?
A what?
A millage, school.
Yeah, exactly. You can have that. There are so many municipalities. Like you can actually go. There's a great site called Emma. It's called the Electron. It's a great site if you're like into financial education for FINRA exams. The
Nerdy.
electronic municipal. Oh my gosh, I'm blanking out. It's Emma. Uh, Emma.com or .org. Maybe you look it up. Anyway, you look it up, you put in your address, and it shows you all the bonds in your municipality. And you're like, oh my gosh, my people that I've elected have borrowed so much money. And then they're all operating in this way where all those bondholders, whoever bought those bonds, is getting the coupon. So you pay taxes to the local government, and then part of that money goes to paying the bondholders, paying the coupons. We've got lots of corporate bonds. And then, of course, there's a whole international market that is very similar. Oh, thank you, Michael. There's the Emma Municipal Securities Rulemaking Board. And then we got the international bonds. So huge, huge marketplace. So what do you think? What do you think? What's bigger? Equity markets, all the stocks out there, or the bond markets, all the bonds out there? What do you think? What do you think? You can answer me on a global basis or US basis. I will accept answers on any side of it. What do you think is larger? And if you want double bonus points, throw a number in there. How big do you think these are? What's the value of all the stocks out there, all the bonds out there.
So
So they're
global,
all
worldwide, and that could either be stocks or bonds.
global is worldwide stocks or worldwide bonds.
Right.
So global equity market, 115 trillion. Global bond market, 140. $140 trillion of bonds that are out there across all of these. And it's sometimes surprising just that the bond markets are much bigger than the equity markets. Now, the recent run up in the equity markets has brought them closer in line. Historically, bond markets were even big, there was an even bigger differentiation, but the bond markets are bigger. There's more lending going on than ownership going on. And I just thought that's an interesting thing. All right, halfway done. Barb, what else we got? Questions, comments, concerns? How are people doing?
Everybody's doing great.
What do you know? You got to let them answer. Or are
Yeah,
you
they
speaking on
really
their
you.
behalf?
And they
Speaking on
love
their.
your energy.
Oh, good, 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 good. I'm
They
just
don't know
kidding.
that you woke up at 4 a.m. because you live in the mountain
That's
time.
right. That's right. It's always early. It's dark here at that hour. All right. So let's talk a little bit about bonds because one of the things that I want to point out is, as a general matter, if people heard this, that bonds are safer, bonds in an investment portfolio kind of soften the ride. People heard that. Is that something people are aware of a little bit? So.
Yes.
Yeah, this is typically the idea that your stocks are the risky assets and your bonds are the a little safer assets. They're not 100% safe, but they're safer. And that very much can be the case. But what I would point out is that in fact, there are bonds that run the whole spectrum. So you just got to be a little more nuanced. When people say bonds are ballast for a portfolio, that bonds are going to smooth the ride, they might, but they also might not. It depends which bonds you pick. So if we look at that same group of bonds that we had up on the prior slide, I kind of map them from safer to riskier, just so you can kind of see how this works. Our government bonds are very safe. Junk bonds, high yield bonds, emerging market bonds, they may be pretty risky. And here's, I want to call back to one of these ideas we talked about before. What kind of coupon, what kind of interest do you think you're earning over here on my US government treasury bonds? High, medium, or low interest? If you say, yeah, we're going to do some US treasury bonds, what do we think? High, medium, or low over here?
They're getting it.
Yeah, you're going to get a low coupon. You're going to get 4%, 3%, right? Depending on how long it is, 3, 4%. Now, let's say you step this way and you're going, now I'm going to go for municipalities and maybe some, medium grade investment bonds. Coupon, high, medium, or low. Yeah, you're going to get some medium sized coupons. And you want to roll the dice, you jump out here. What kind of yields are you looking at when you think about the junk bonds? What do you think you're doing at over there? So we're like 4%. Maybe here we're 5 to 7%. And out here, you could be doing like 10 to 14%. High risk, high reward. Exactly right. Exactly right. And I want to take a minute and just kind of begin to introduce how this risk manifests because it can show up in a couple of different ways. So when we talk about bonds, and this is going a little deep, but everybody's with me. So we're going to jump in. We're going to talk about what are these risks. I'm actually going to start on the right-hand side because I think this is a risk people can get their head around. Credit risk, it's called. Now that's jargon. Credit risk. Credit is lending. When you buy bonds, you're giving credit. And the big risk as a lender is that your borrower defaults. They don't pay your coupon. They can't return your money. You show up with that coupon you've clipped, and you know what the bank says? Oh, that bond, they're not paying. Sorry. And that's the risk. And that can happen. Companies file for bankruptcy. Companies don't have the money. Companies disappear. They've defaulted and you have experienced credit risk. So they simply don't meet the agreement. Just like when you take a loan out, you borrow money to buy a car, buy a house, the bank has credit risk to you. That's why they make you put 20% down. That's why they ask you, what kind of income do you have? That's why they ask you, what's your job situation? They ask you all those things to try and evaluate how much credit risk do you have. Now, I'm going to go through these other three just with the lightest of touches because they're a little more complex, but moving right to left, a little weird, but we'll move right to left. Inflation, what was another name for these instruments about the income you get? What was the kind of income you get? Did it vary? Is it a fluctuating, adjustable kind of income? There you go, Cheryl. No, it's a fixed income. So you're getting, how much was our bond paying? You're getting 45 bucks every 6 months. But if you're trying to buy eggs, I think eggs is the joke, right? The inflation joke right now. You're trying to buy eggs, $45. That's like three. I think you get three eggs now for $45. That's the problem. Because next 6 months, it's still 45 bucks. And in a year, it's still 45 bucks. So you are facing inflationary risk. If any of you have a fixed income heavy portfolio and the cost of goods are going up, and you're like, oh man, like this is a problem because my income stream is flat. That's inflationary risk. The other two risks, a little more nuanced, call risk, that they call the bond in and they pay you back early. It's like prepayment, or interest rate risk. That's if you're going to sell your bond, and that's going to drive the price if you do it. So before I flip to the next slide, what do you think over 200 years? Now, none of us are going to probably last for 200 years, but what do you think? For 200 years, which of these investments do you think has done best? Stocks, bonds, gold, staying in cash? What do you think? 200 years. That's a little crazy. Anybody got an answer? Anybody willing to show up? Some people go in bonds.
Got bonds.
A lot of bond investors over the long term. Which is going to be our riskier asset? Stocks are. Stocks are going to be our risky asset. And over the long haul, they perform. So here you see a chart. This is a little bit of a crazy chart. From 1800, that's 225 years ago, to 2000, 200 years, $1 invested in stocks turns into 750,000. $1 invested in bonds only turns into 1,000. And right there, that is the risk return manifest. You can see that stock line. It's up and it's down, and it's up and it's down. And those downs are real, and those downs hurt. But when you begin to look at the longer perspective, you can see that taking on that greater risk has yielded greater returns. Now, of course, we always have to say past performance doesn't guarantee future performance, but this is a long history to look back upon. And so maybe what you're thinking is, well, that's all good and well, Dave. I don't really want to deal with picking which stocks and which bonds and knowing should I buy or should I sell and what's going on in the market. Because like I've got a job and I've got kids and I got a family and I don't even like this stuff. And so what companies like yours and others have done is created various funds. And these funds are investment companies. They have names like mutual funds, exchange traded funds, closed end funds, with all slightly different features. But at the end of the day, they all do the same thing. You get to show up and make one investment, and you get a big pool of underlying securities. So you get the diversification, you get the convenience, you get management, and you get liquidity. Liquidity means they are able to easily sell. Liquidity is one of those terms. I always describe it this way. I say, if you're holding a liquid in your hand, how easy is it for it to just flow through? Just flows right through, right? There's nothing stopping water in your hand. It's very liquid. It moves. So if you have a liquid investment, it's easy to move. You can sell it easily. You can buy it easily. Illiquid, like rocks, if you're holding rocks in your hand, they don't just like flow out easy breezy. So that's why I always think about liquidity. It's just like, oh, that's liquid. It's just going to flow wherever you want to put it. You can put it. The downside of funds, you got to pay. You got to pay those people to make the investments, to do the research, to run the process, to have a person you can call. and you don't have as much control, but you want to usually give that up anyway. So let me show you how this works. Now, how many of you think you have or own mutual funds or ETFs or closed-end funds? Anybody know? If you invest in a retirement plan, you almost surely do. You may just not know which one or which kind, but I'd encourage you to go check it out after our talk here and kind of understand this. Because when you buy funds, there is a vast menu. My colleague Michael talks about it's like going to the supermarket. You can go into the stock aisle, walk down that thing, and it's like, wow, hundreds of different kinds of stock you can buy. You go to the bond aisle, there's probably like 5 aisles of bonds, right? Your govy bonds, your agency bonds, your muni bonds, all of them. And then you can go into the like prepared foods aisle. And they've done it all for you. They've gone and they've picked this stock and that stock and this bond and that, and they package it up and they're like, it's good to go. But you know, you pay a little bit more for it. So here's how it works. Let's say you want stocks. I'm only interested in stocks, but I want the diversification. I don't want to fool with picking them. So you say, I know what I'll do. I'll go and buy VPCCX. Why not? That's a great ticker right there. You buy one share of VPCXX. You now own an investment company that owns a whole portfolio. By you making one investment, you have now become an owner of 174 shares of stock. And some of these companies are familiar to you. Eli Lilly, AstraZeneca, Microsoft, Amgen, KLA, JP Morgan, Alphabet. That's what you own. You don't have to go and pick the individual stocks because you bought the fund that holds them. So you get, with that one investment, what's that keyword? Started with a D? You get the diversification. Even though I only own one thing, that one thing I own is a widely dispersed pie, or pool is the term they often use. Let's say you're more into bonds. Well, you buy a bond fund like VMSIX. I just looked these up last night, picked up some, these are Vanguard funds. That's why the V's there. And the bond fund, what am I about to show you? What's going to be in the portfolio? Are we going to see one bond? You're going to get one bond if you buy the bond fund? What do you think? How many bonds? Who's got a guess? Who's got a
Multiple.
guess? How many bonds in the VMSIX bond fund? You can see that the stock fund, they did 174. They picked 174 stocks. How about in the bond fund? Who's got a number? 237, 350. In the bond world, you go crazy. 1,000 bonds. You bought one fund, you got 1,000 bonds. So if one of them defaults, if Carol, you were close right there. If one of these bonds defaults, like the Service Corp International 3 3 bond, if it defaults, do we care? I mean, we're a little sad, but it's one of my 1,000 bonds. So I've taken a lot of the risk off the table, and I don't have to worry about fooling with which bonds I want to buy. You think you get a fund that does stocks and bonds together? What do you think? Stocks and bonds together? You know we can, right? These financial services in companies like yours, maybe, they know if the market wants it, we're going to create it. So we'll put together a little balance fund. We'll throw the stocks in there and the bonds in there. And look at this. You get 74 shares, you get 1,200 bonds, and all I had to do was make one investment. And that is the way that the funds work to allow you to get professional management, get the diversification, and not need to be as closely connected to the market. But of course, you pay for it. And so those are trade-offs that you should think about. We have about 15 minutes left. We're going to hit some topics that we talked about, a little review, introduce one or two new things, talk about our giveaway, and then we're going to do some Q&A. So diversification, we talked about this. It's about spreading it out. You can spread things out within asset classes. So lots of different stocks instead of just one stock. You can spread it across asset classes, stocks and bonds and real estate. You can do it geographically. You can do it investment style. You can do it sectors. What diversification does is smooth the ride. Let me show you. How many of you have heard of the S&P 500? That's a basket of 500 companies. Coinbase just got put in the S&P 500 because S&P is a private company and they just pick who are the 500 largest U.S. headquartered companies, and they pick them. So look at this chart. Equifax in blue. Data broker, credit company, they're going along just fine. And then they have a major data breach. which was horrible because they are like the repository of all of our data. And the stock rightly got hammered. And look at it on the S&P. You can't even tell on the orange line. That's diversification happening right there. You can't even tell that any one stock did great. But I don't want to misguide you. What about a company stock that went 40% up? If you own the S&P, what's going to happen to your S&P? And one of the companies is 40% up, S&P just chugs along. So you're taking that risk off the table. You don't get the downside, but you also are going to miss some of the upside. It all rolls together. And the other thing that I think is super cool, this is a crazy slide. Wow. I got to annotate this so we can get a little direction going here. This shows you over the past 20 years, what asset has done best? What asset has done best? And I just want you to look generally. On the top row, who's done best? Well, sometimes it's purple commodities. That's like buying metals, copper and iron and gold. And then the next year, 2006, it's real estate. It's buying REITs. And then the next year, it's commodities. And then it's bonds. And now it's large cap growth. That's stocks. Back to real estate. Now it's bonds. Now it's real estate. Now it's small cap stocks. So what are you seeing? Well, you're seeing that at the top, there's no one investment that always does the best. And also, if you look down at the bottom of the chart down here, you see some of those same players that were up at the top. This is where I do my football analysis, Barb, right? X's and O's here. The guys who get to sit at the top, you know where else they go? They go at the bottom. And if you wanted to see about diversification, check it out. Diversification, you roll just down in the middle because you're bringing it all together. That's diversification in a nutshell. And I felt like this, while hard to kind of really parse, you pull back and you're like, oh, I can just kind of sit across and ride the middle. John Madden. Yeah, I always love a bus. I love a luxury bus. That guy knew
I
how
was
to
thinking
travel.
about the night of the election when they have all of these
Oh, on the board? Yeah,
yeah.
the board. No. The X's and O's. We're running plays here. So this is kind of when you pull back and say, all right, why do I want to diversify? Well, because stocks crushed in the past 5 years. But look, they're also on the very bottom. So that would have been that's a way to think about this. Last couple ideas here. Here we go. 6% rate of return. We're just going to assume 6%. I want you to think about two people. Talk to the beginning. If you didn't start a long time ago investing, the next best time to start is probably now. So you got Alex on the left-hand side, 25 years old, does 10,000 a year. So that's a lot, right? Almost 1,000 a month, a little less than 1,000 a month, but for 15 years. So 150K invested. Bobby does 10,000 a year, but for twice as long, invests twice as much, but later in time. Who's coming out with more money, or are they the same? Who's coming out with more money? 6% rate of return. Who's coming out with more money at 65? A lot of people got the gist, heard the message. Starting early allows for what concept that we talked about at the beginning? All of this growth on the green line is compounding. It is growth on growth. Alex only put 150K in, but ends up over 200K further ahead because in these last years, Alex's investments grow dramatically on their own. Not by putting new money in, but because of the amount that has grown, that it is still churning. And in fact, the majority of the growth comes at the end. Now, if the rate of return's higher, because 6% is pretty conservative over this time period, Alex would be doing even better still. Starting early is very valuable. Here's that same idea. You can see the growth at the end is huge and far outweighs the original amount that you put in. Now, a couple other things about time. I think it's just so interesting. So here we're looking at individual years on the stock market. Green is up, red is down. It looks like a pretty wild ride. How many years, as you eyeball this, do you think that we've got green out of every 10? What do you think? How many out of every 10-year window are green, meaning the market's up? More than half, Rhonda says, yeah. Yeah, it's about 7 of every 10 years, the market is up. Not always up big, a lot of big wins, not always. And every 3 years, there's a loss. It's a wild ride. I don't know how many of you were invested in 2008 or maybe 2018. Those hurt. Those can really hurt. So what I show you is when we look at this individual yearly basis, it looks pretty wild. But check this out. If you pull back to a 10-year period or go to the lower chart, a 20-year period, there has not been, this doesn't mean it couldn't happen, but up until now, there has not been any 20-year period, and the vast, vast majority of 10-year periods, where you have a loss after that time period. So pick any year, 1942, 1967, 1987, 2002. Whenever you invest, if you go forward 20 years from that, what this chart is showing is that you didn't actually lose money. Now, if you go back year to year over any 20 years, what are you going to see? You're going to see this. But if you can pull back that perspective, over the long term, it's going to pull forward and actually historically indicate that it would in fact be positive. So when you think about investing and you can take that longer term perspective, as a general matter, do we think you can take more risk or less risk? More risk or less risk? Yeah, we generally think longer time horizon, you can take more risk. Still want to be diversified. Still want to be thoughtful about the amount of risk, but with those longer time horizons, things change. So he says, what about if I'm already 60? If I'm already at age 60? You know the funny thing? If you're 60, you still have 25-year life expectancy. Once you're 60, you're still expected to live another 25 years. And you're going to need money when so there's obviously unique and individual elements that are, of course, useful to think about. But I do think that even if you're, starting retirement now, right? The general idea is that you want to be thoughtful of how much longer does that nest egg have to last, and do you need to have assets at risk to generate those returns? So with
The
that,
question may have been, what if you're just starting at 60 to invest?
and even if you are, yeah, I think even if you are, you can still think about what is that expected timeline. There are, of course, other considerations, right? If you're retired and you don't have an income, that is a big factor. But there's no free lunch. That's the thing. You can't say, I don't want to take the risk. You could say that, but then you have to do something else. And there are risks there. We talked about some of the risks with fixed income, and we talked about some of the things with just holding cash, where you have really inflationary risk. All right, let's talk about questions that we've got. What are exchange traded funds? Okay, great question. So those are the funds that we saw, and they just trade during the whole stock day. So from 9:30 to 4, you can buy. These are mutual funds. So you can only buy these once a day at 4 p.m. These same ideas exist as exchange traded funds, and you could buy those individual funds over the course of the day. So the big difference between ETFs and mutual funds is when you can buy them. There's not a really economic difference between them. What's a good resource if I'm just starting out? There's a lot of excellent books out there. What do you want to think about? I think is, are you looking to get out of debt? And there's kind of a whole line of educational materials. It's like if you're in a lot of debt, you have student loans or other loans, that kind of period of your journey. And then if you're out of debt and you're thinking about, I want to grow, then you're looking for things like that. And I can think about it, Mariah, and come back with maybe a couple recommendations. When a company issues new stock, how does it affect its current shareholders and how's it navigated? Great question. So we talked before about if you issue stock, you're going to have a pie like that. This company has 16 shares. So if this company issued additional shares, the company's not worth more. Think about Disney, 1.8 billion shares. Let's say they double the shares. And now there's 3.6 billion shares. Is Disney more valuable as a company? It's the same company. They have the same parks, the same movies, the same merch. So each share of stock would be worth half as much, right? Now, depending on what exactly you're thinking about, Greg, if I sell those shares, well, now the company could be worth more because what did the company get when they sold shares? Capital, money. So maybe Disney sells some shares, but has cash in the bank. So it did get more valuable. So there's a couple different paths down that question. What are stock options? Great question, Colleen. We gotta come back to that. But an option is the right to buy a share. So if I had Disney stock options, they would say to me, Dave, you can buy Disney shares at $100, locked in price, $100. So if it's this period of time, that's my purchase price. So if the stock's worth, 110 and my option is at 100, I like things because I get to buy something for 100 that's worth 110. But if my option's at 100, my fixed purchase price, but the stock's down here, not going to do it. And it's my option. It's my option. Last question, somebody asked about a fiduciary versus just financial advisor. So most financial advisors are fiduciaries. Fiduciary means that that advisor must put your interests first, including and above their own, because advisors or stockbrokers get paid to sell funds like this. And so a fiduciary would have to sell you the fund that's best for you, even if one of these other funds might pay them more. So a fiduciary is a great tool. Barb, tell them about what we are doing for them. Oh my gosh, there goes the whole screen. Never like to see that. Oh my gosh, behind the
Yeah.
curtain. Go ahead,
So
Barb.
we do. We do have a giveaway for everyone who attended today. If you are interested in getting this course, so this was really like the Evelyn Wood speed reading version of our How to Finance course. But we would like to give that course away for free to anyone who's interested if you have attended this webinar. And so that is several more hours of interesting information hosted by Dave. So, he's fun to listen to. And in order to receive the free enrollment, just send me an email, barbara@notman.com, and I will send you the code for you to register for the free course. And it's all video based. And I think you're really going to love it.
Yeah, so just email Barb, tell her what was the light bulb moment, what did you like best?
Yeah.
If you didn't like anything, tell us that you hated it, but then I don't know why you want a free course. So, but yeah, the course is awesome, and it's me and some of the other Notman faculty just jamming just like this, and there's an awesome glossary in it. You can see I kind of put that behind. So all those words and terms and things that you're like, I hear that all the time. What does it really mean? Like, just tell me really what it means. That's in that course. So send her a note, let her know who you are, let her know what you liked, and this would be great. And I'd love to see you all in that course, asynchronously, of course. That would be great. Julie?
Okay, Dave, thank you so much for this fun and, dare I say, a magnificent presentation and for sharing your expertise in financial knowledge. Also, Barb, thank you. We love it whenever you're here to give us a helping hand. Thank you for being a friend of SILA and the SILA Foundation. We appreciate both of you and your time this afternoon. As a reminder to everybody else, our webinars are free of charge. They're open to the public. We love it when you share our invitations. Watch for and complete the post-webinar survey and plan to join us next month when we talk about adjuster licensing. Thank you, everybody.
Thanks all.